All right, good morning everyone. We're gonna do the third video. We're gonna go continue the practice questions. We're gonna actually do 9, 10, and 12 in this section. Chapter 11 is kind of very lengthy, so I'm gonna do that one probably on its own. But right now we're gonna do 9, 10, and 12. Okay, and we'll probably do annuities twice just to make sure that if there's any questions that we miss or that they double up with, we can answer those as well. Okay, annuities is a good one. I took my exam 5-6 years ago. Annuities was a good 50-60% of the actual exam. Riders, provisions, annuities, those were the heavy chapters back then. I haven't taken it recently, so I don't know how the tests are, but let's start on annuities. The main purpose of an annuity is A, create a stream of income, B, provide a death benefit, C, provide tax shelter, D, create an estate. Now, the one thing to know about annuities is annuities are the complete opposite of life insurance policies. Okay, with life insurance, you create an instant estate. You may pay a little bit to receive a lot potentially. It is tax-free with the life insurance policy, everything from cash value to death benefit. But with an annuity, it's different. All right, annuities is a type of retirement plan. So just understand that with retirement plans, you are going to have to pay taxes. They are deferred. They are not tax-free. All right, so annuities are not tax-free. And another thing, too, is that it's not going to give you more than what you put in other than the interest that it earns. Okay, it's not like life insurance where you can pay $100 a month and get like $1 million of coverage. There is no transferring of risk. A life insurance is exactly a transfer of risk, but an annuity is literally a retirement plan where you put your money in, it earns some interest, and that's really the ballpark of that game. Okay, so the main purpose of an annuity is to create a stream of income, all right, for retirement. It does not have a death benefit. There is no tax shelter. You will not get anything tax-free other than the money that you put in that was pre-tax, if you put in pre-tax dollars. But other than that, it's not going to create an estate either. Okay. Which of the following is not a valid contract exchange? So with exchanges, you can only do like to like. Okay, so if it's a retirement plan that is pre-tax, it can roll into or an exchange into another pre-tax retirement plan. Okay, so that's something to keep in mind. In this case, a life insurance policy exchange for another annuity, an annuity exchange for a life insurance policy, an annuity exchange for another annuity, a life insurance policy exchange for another life insurance policy. So if you look at C and D, you know what I mean? An annuity to an annuity, that is like to like, okay? Apples to apples, orange to orange. So those two are not going to be the answer, okay? Those are valid contracts. You can go from an annuity to an annuity, a 401k to an annuity, an IRA to an annuity, vice versa. A life insurance policy to a life insurance policy. You're not going to go from a term to a permanent policy. That would be a conversion. All right. When we do an exchange, it's a like for a like. So a whole life can be exchanged for an IUL. All right. So the other two, a life insurance policy exchange for an annuity. I mean, that's not. Let me see. That's not technically. I mean, you could pull a lump sum out of a life insurance policy. I don't know if you would call that an exchange though, but in this case the answer is going to be an annuity exchange for a life insurance policy, mainly because an annuity is tax deferred and you're rolling it into a tax-free vehicle. So if you were to do that, you would have to pay the taxes, okay, before it can become a life insurance policy. You're not going to be able to, like, let's say you accumulated $1 million in an annuity or a 401k or an IRA. You can't save all $1 million to roll into a life insurance policy and expect that to be now tax-free. Okay, you'll have to pay the taxes, and then whatever after taxes and penalties, if penalties apply, then you can buy a life insurance policy with it, but it cannot be exchanged into a life insurance policy. Who typically makes the purchase payments in an individual annuity? All right. In an individual annuity, it's probably going to be the owner. Okay. There's no insurer. There is a beneficiary and there are trustees. But the owner is going to, because it's your own retirement plan, you know. An individual age 45 would like to help pay for his daughter's college expenses in 10 years. Which annuity would be appropriate for this individual? All right, so there's two payment styles when it comes to annuity. One is going to be deferred. Deferred just means that it's going to be distributed down the line somewhere. So you're going to put money in, you're going to let it accumulate and grow, and then you're going to take out money down the line. Or you can have an immediate annuity where it starts paying out, or distribution starts the month after. Okay, the actual word for an annuity would be annuitized. Okay, so when it is annuitized, the payments start paying out, and you could either set it up to be immediate, which is a month later, or within the year, or deferred, which is something that's over a year later. Okay, so for someone that's 45 looking to accumulate money for 10 years to pay for the daughter's college, this would be a deferred annuity. Which of these pays an income to two or more annuitants until the death of the last annuitant? This is going to be the same as the life insurance when it comes to joint and survivor. So this would be joint and survivor annuity. A joint annuity would be, it would start paying out after the first person passes. But in this case, until the death of the last. So yeah, this is when the second person passes away. So it's going to be joint and survivor. All right. If it's just the first person, then it would be a joint. A retired couple would like to maximize the income derived from their combined life savings and have it payable until they both die. Which annuity would be their best choice? Until they both. It would be survivorship. Joint. It would be survivorship. Joint and survivor. It would be a joint and survivor annuity. Joint and survivor until they both die. A joint survivor annuity covers two or more lives and continues in force so long as one of them survives. A retired couple maximize income derived from their combined life savings and have it payable until they both die. That wording is kind of confusing. It sounds like they're trying to annuitize until they pass away. And that would be probably more like income for life. An annuity which starts paying monthly benefits within a month after issuance, all right, is called, and it's not a deferred annuity. They're looking for monthly benefits within the month after they issue. It would be an immediate annuity. During the liquidation phase of an annuity contract, to whom are the income benefits normally payable to? Again, this is a retirement plan, not an insurance policy. All right. And the reason why that's important is because sometimes people might automatically think beneficiary, because in an insurance policy, the beneficiary would receive the payments. Okay. But in a retirement plan, if you're setting up a retirement plan for yourself, you would be the actual receiver of that annuity contract. Can you change it? Yes, but it would be the annuitant or the person that the annuity is designed to pay out to. Can you set up an annuity for someone else, like your children, to be the annuitant? Yes, you can. The authority to change the beneficiary in an individual annuity lies with the owner. Okay, the owner, for whether it's life insurance or annuities, only the owner can really make that kind of a change, unless there's some holds or some conditions to it, like an irrevocable beneficiary. But in this case, most policies or contracts, the owner has the right to make the decisions. The interest credited to the cash values of personally owned non-qualified annuities is considered tax deferred. Okay, the interest credited is usually tax deferred in an annuity, just like a 401k or an IRA. The reason why we set it up is so we can defer the taxes until we actually take distributions in the future. the contractual rights which allow the owner of a deferred annuity to surrender the cash value several years before the annuity date are called the contractual rights. It's going to be the surrender options. All right, that's going to be pretty much the same cash value or the money that's in there. The difference between, they're still considered surrender charges, okay? With annuities, you have maturity dates. So if you buy a 5-year, 7-year, 9-year annuity, you have to keep the money in there, the principal in there for 5, 7, or 9 years, respectively. For life insurance, it's either a dollar amount. You gotta meet that dollar amount, or it's going to be 10 or 15 years. That's predetermined by the provider, okay? So the surrender of the cash value is gonna follow the surrender options that comes with that annuity. Okay, all right, so I got that one wrong. The non-forfeiture options. Non-forfeiture is also cash value. The correct answer is non-forfeiture options. If the owner of a deferred annuity surrenders the contract several years before the annuity date in exchange for the cash value, the owner is said to be exercising contractual rights called non-forfeiture options. When a large sum of money is used to structure monthly payments, which product is typically used? A large sum of money, inheritances, lottery tickets, life insurance payouts. They usually go into an immediate annuity. The surrender charge on many deferred annuity contracts are waived. The surrender charge on many deferred annuity contracts are waived when the annuitant dies or becomes disabled. Contract's interest falls below a stated percentage. Contract is canceled within the first year. Annuitant becomes unemployed. Annuitant dies or becomes disabled. The surrender charge on many deferred annuity contracts. It's either A or B. The surrender charge. You know what? This is tough. I'm gonna go with A. I know B does come with something. I just forgot what question it is. When determining the accumulation value of a deferred annuity, the total is calculated by taking the premiums paid plus interest earned minus when determining the accumulation value of a deferred annuity, the total is calculated by taking the premiums paid plus interest earned minus expenses and withdrawals, surrender charges, taxes owed, bailout option. I'm going to say taxes owed. Expenses and withdrawals. The correct answer is expenses and withdrawals. The accumulation value of a deferred annuity is equal to the sum of premiums paid plus interest minus any withdrawals and expenses. That makes sense, I guess. Which of these annuity contract features is meant to discourage withdrawals and exchanges? Withdrawal penalty, annuitization, annual fees, surrender charges. Surrender charges. I'm telling you, annuities. I don't know, something about it. Alright, let's do that again. Let's see if there's any new questions that we didn't come across. You can see even before I didn't even score 100. I got a 93. Something about the wording for annuities. The main purpose of an annuity is to create a stream of income. Alright, which of the following is not a valid contract exchange? You cannot go from a life insurance policy to an annuity, or you cannot go from an annuity to a life insurance. I'm going to say annuity to life insurance. You can't go from tax deferred to tax free and expect the same benefit. Who typically makes the purchase payments in an individual annuity? Usually the owner. An individual age 45 would like to help pay for his daughter's college expenses in 10 years. Which annuity would be appropriate for this? Immediate or deferred? It's going to be deferred. Which of these pays an income to two or more annuitants until the death of the last annuitant? It's going to be the joint and survivor annuity, because we're looking at the second person to pass. A retired couple would like to maximize the income derived from their combined life savings and have it payable until they both die. Which annuity would be their best choice? Until they both pass away. An annuity which starts paying monthly benefits within the month after issuance is called an immediate annuity. During the liquidation phase of an annuity contract, to whom are the income benefits normally payable to? It's going to be to the annuitant. The authority to change the beneficiary in an individual annuity lies with the owner. The interest credited to the cash values of personally owned non-qualified annuities is considered tax deferred. The contractual rights which allow the owner of a deferred annuity to surrender the cash value several years before the annuity dates are called non-forfeiture options. This is the one I got wrong. When a large sum of money is used to structure monthly payments, which product is typically used? An immediate annuity. Just think of a lottery winning. They give you the option of taking the cash lump sum, which you end up getting a little bit over half. You lose a lot of it. Or you can take the 20-year annuity payment where you'll get the full amount. The surrender charge on many deferred annuity contracts are waived when the annuitant dies or becomes disabled. When determining the accumulation value of a deferred annuity, the total is calculated by taking the premiums paid plus interest earned minus expenses and withdrawals. This was another one that I got wrong. Which of these annuity contract features is meant to discourage withdrawals and exchanges? I think this was another one that I got wrong. And I'm about to get it wrong again. Surrender charges? I think I put surrender charges last time. I don't even know. I mean, it's either one or the other. Withdrawal penalty. Oh, man. Oh, my goodness. Surrender charges. Just can't get 100 on this chapter. Alright, well, that's chapter 9. Most of the questions are the same. We'll move on to 10. Uses of life insurance. Uses of life insurance. Which of the following disability buy-sell agreements is best suited for businesses with limited number of partners? Cross purchase agreement, split dollar, key person. Probably going to go with the cross purchase agreement. Key person is usually someone that does really well for the company, someone like a top salesperson or something, that if they lost that person, they would lose profits, or they would, have some sort of financial loss. Split dollar, a really good example of split dollar, I believe, is Jim Harbaugh, the coach from Michigan, and the way they set up his contract agreement, which is a great story. You should look up Jim Harbaugh, Michigan. What is considered a valid reason for small corporations to insure the lives of its major stockholders? Fund a buy-sell agreement to provide an income for surviving dependents to pay for final expenses, reduce the company's tax liability. I mean, they do reduce the company's tax liability, but that's not the main reason why they would do that for the major stockholders. To pay for final expense, I'm sure that's not going to be their concern. To provide an income for surviving dependents, not really. I mean, they offer life insurance anyways, but we're talking about a small corporation buying it on the individual versus, offering the individuals to buy their own life insurance, or buying a group life insurance and just covering everybody. When using the needs approach for life insurance planning, a lump sum may be created to provide for all of the following except employee benefits, education, final expenses, charitable donations. It's going to be employee benefits, I believe, mainly because everything else you can kind of buy and set up, but employee benefits is kind of like an ongoing thing. The best product for that would be an annuity. Which of these factors does not influence an individual's need for life insurance? Which of these factors does not influence? Lifestyle of the applicant, that does influence. Future educational costs of the dependents, that will influence. The number of dependents will also influence. Self-maintenance expenses, I don't think your haircut and massages really get factored in. Alright, it's going to be self-maintenance. The premiums paid by an employer for his employees' group life insurance are usually considered to be tax deductible. Okay, so the premiums paid by an employer for his employees' group life is tax deductible to the employer. Taxable income, nope. Tax deductible to the employee, nope. They have no deductions. Partially deductible to the nope. So it's going to be tax deductible for the company. Which of the following is not considered to be an expense for surviving family members of a deceased wage earner? Which of the following is not considered to be an expense for surviving family members of a deceased wage earner? Unemployment tax, estate tax, funeral expense, living expense. I'm going to say unemployment tax. Which of these is not considered to be a cost connected with an individual's death? Funeral expense, tax liability, business expense, probate costs. Which is not considered to be a cost connected to an individual's death? Funeral expense is a yes. Tax liability would be a yes. I'm going to go with business expenses. Because a business should have their own, all of the considered except for the business expense. Alright, so that's chapter 10. There's not going to be too many questions out of that. I think if we did it again, it would be the same questions. 11, like I said, is pretty lengthy, so I'm going to go to 12. 12 is a very short chapter 2. I think it's 10 questions, and it's the same questions if you take it over and over again. But 11 is going to need its own little video. Alright, what is the maximum Social Security disability benefit amount an insured can receive? What is the maximum disability benefit amount an insured can receive? I think the first answer is the exact same as the question, so that's not it. 100% of the insured's primary insurance amount, 75%, 100% minus any money received from a retirement plan. I'm going to go with 100% of the PIA. Okay. What determines the full amount of Social Security retirement benefits a qualified individual is entitled to receive? I'm going to go with that one just because it was the same as the last question, different form. A lot of these things, to be honest, like after you pass this test, you'll probably rarely ever see it in the field or in play. What is old age and survivors health insurance also known as? Old age and survivors health insurance. I think that's Social Security. That's what they're paying into. The chapter is Social Security. One becomes eligible for Social Security disability benefits after having been disabled for, I believe this one was 6 months. Oh no, actually I made a comment. It was such a 5 months. After 5 months. Q is severely injured in an automobile accident and becomes totally disabled. How many months must Q be disabled before being able to apply? This is going to be the same as that last question, just with names. 5 months. Okay, so like I said, Social Security is a pretty small chapter. Very straightforward. You just need to know that, you know what I mean? At least understand the basics of it. I don't think it's going to, you know what I mean, be too difficult of a problem. But other than that, this is going to be the end of this video. I'll create another one again just for chapter 11 because it is, we could probably go through it 3 different times and it'll probably give us 3 different sets of questions.